I'm joined now by Philippe Gijsels from BNP Paribas Fortis Global Markets. Thank you so much for joining us. Philippe, there's so much talk actually that we're going to be in a kind of seesaw, markets for the next couple of months, if not a year or so, because, well, one day economic is better than expected, the other data is weaker. Where do you stand on this?
Well, that's exactly right. We've been talking before the summer already that we saw volatility going on through the year. That's exactly what we saw over the summer. And that's also what you expect for the autumn, because the market is still trying to work out whether we will slip in a double-dip recession or not. And like you say, just during the August month, we had horrible figures out of the US. Europe was much better. And now last week we got better figures out of the US. ISM much higher than expected. And also the non-farm payrolls figure that was much better than expected. So the market still tries to work this out, basically.
So how do you actually handle this? I mean, are you just in a wait-and-see situation, see what exactly the economic data shows? Or are you ignoring the economic data to try and focus on good deals out there on the markets?
Well, we've been telling clients for a while now to be cautious. Of course, when you're an investor, you look at this from a longer term perspective. When you're a trader, of course, you can try to play these up and down moves, but also timing the market this year has been very hard to do, basically.
So what type of investments will you be looking at? I mean, today we have a lot of tech stocks on the higher side, a lot of the utilities. Do they seem like safer bets?
Well, if you have to be in equities, basically, we look mostly for more defensive plays, high dividend plays. For example, utilities are a good example of this. I still think this sector is reasonably expensive, but still they pay a nice dividend, and as interest rates go down all the time, it's a very nice way to look at. Technology is also not too bad because they had a very strong earnings season, and they also, when the deflation is the problem, technology stocks used to live with deflation, so they tend to do very well. So these would be two sectors we like.
Philip, I really like how you started that answer. Well, if you have to be in equities, I mean, is there an asset class which you actually consider as better value?
Well, it's very hard because a lot of people are also talking about the bubble in bonds because interest rates are so low, so it's very hard to get yields, and that's exactly the problem that a lot of pension funds and insurers have at the moment. You have to find yield somewhere, which means you have to take some risks. Individual investor is a little bit easier. You can say, okay, I sit in cash, or I sit in a 10-year German bond. I get 2% yield, but I'm happy with that, but at least I'm not losing money. So that's also an option you can take.
So how much cash, for example, you keep in your portfolio? Are we talking 30, 40%?
Well, that depends highly on every investor and the long-term perspective that you have, but I think we recommend investors to have above average amount of cash at the moment.
Philippe, it does seem that the economic data is pretty murky, as we've been saying. Are you expecting anything from the finance ministers over the next 2 days to possibly appease investors on what they're looking at?
Well, I think they will continue on the road that they are at the moment, and I think they're quite happy with themselves a bit because they had the stress tests before the summer that passed very well in the market, and then the market rallied a bit. The weakness we saw over the summer was not from Europe, came from the US and impacted Europe, but the economic figures out of Europe were fairly good. We also think that will slow down a bit towards the end of the year, but still, if you look at it, Europe is not in too bad shape, so I think they will try to continue to restore confidence, but I think they've already done quite a good job at the moment.
Oh, so are you concerned that actually the austerity measures put in place will stifle economic growth by too much, or are you okay?
Well, that's the $1 billion question. If you look at Ireland, for example, they started early with all these measures, and the economy is having a very hard time. They're in deflationary territory, so if everybody starts to do the same thing, you run a risk of slowing down materially in the second half.
Philip, thank you so much. Philippe Gijsels there.